Yes, that is a 1980 Gibson ES335 reissue of the famous cherry red dot neck that Chuck Berry used to play, actually, and it's considered a collector's item in its own right because the guitar is one of the first 200 made of that particular model year. And it's considered in every respect just as good as the originals. Now, of course, I'm not a guitar player by profession. These days, I am Ted Bauman, the ringleader of the Bauman Daily circus. Oh, sorry, almost forgot. That's not my job. I'm actually the editor of the Bauman Letter, which you can subscribe to up here in the upper left-hand corner. I hear you guys. Thanks. I love you too. This week, I want to talk about really an opportunity that I see coming up, but it's not going to be something that will materialize until the virus is under control. Now, as we know, I'm not going to belabor the point, but the virus is not under control. In fact, things are getting a lot worse, and I think it's going to take some time before the real economy begins to recover. And of course, as you know, I am a fundamentals guy. I'm concerned about earnings in the real economy, and maybe that sets me apart a little bit from people who are more on the speculative side. I know a lot of you guys are. It's just a different style of investing. And I think it's important to understand that I'm talking to a crowd, really, to be honest, a lot of my subscribers, probably the majority of them, are people who are retired and are looking to basically get good risk-adjusted gains. Kind of gains that we've been getting so far this year. Some of them have been great, I acknowledge, particularly those of you who have been willing to place bets on companies that are, but have been beaten down. But I think in the long term, it's just a different investing philosophy, and I think it would be useful to acknowledge that there are different approaches. This is mine. Now, I want to talk briefly about, I want to revisit what I spoke about last week, which is the danger that we do not get a resumption of some kind of economic stimulus. Right now, the stock market, of course, is being driven largely by the activities of the Federal Reserve. Now, whatever you may think about that, the reality is that that's what's keeping it afloat. It's a combination of keeping long-term interest rates down and short-term interest rates as well. Also backstopping credit markets so that companies don't all have to go bankrupt. Some of them who would are benefiting from corporate credit markets which have been supported by the Fed. And more generally, just the confidence boosting that the Fed gives to the market. I get that. Of course, as I've argued all along, the further we get away from the fundamentals, the more there is the possibility of a correction. And we have seen corrections in the last 5 years. Those of you who forget maybe the December 2018 around Christmas time. And also we saw a big correction in 2019 at the beginning of the year. So yes, these things do happen. So my thesis really is that we need to see a continuation of support to the economy by the federal government in the form of stimulus, or rather, shall we say, support. Stimulus is not really the word, income support. And the reason is, of course, simply that the money that the federal government provides to people who would otherwise be earning money in restaurants, bars, in entertainment complexes, hotels, cruise ships, airports, airlines, all those people, if they lose their incomes, they can't spend it, which means that somebody else loses their income, which in turn means somebody else loses their income, and so on and so forth. So anybody who has seen or taken a Econ 101 course will know that the circle of spending means that if the government doesn't continue pumping money into the economy, and if the economy can't recover because the virus is still out of control, then we are in for a world of hurt. Whether that means that the stock market is in for a world of hurt, it's anybody's guess. I acknowledge that I underestimated the extent to which people's sentiment would continue to push the market up. And on that score, yes, you win, guys, up till now. But remember, it's who has the last laugh is the important thing. But let's not dwell on that. Today, what I want to talk about in detail is the basically what I see as a rotation, which is likely to come in the near future. Now, again, this depends on the recovery from the economy. or rather from the virus. So let's talk first about how fund managers and other institutional investors are looking at the situation as a whole. Well, right now, two big commentators in the market. One, the Bank of America annual survey of fund managers. They conclude that right now the long bet on large cap technology firms in the United States is one of the essentially the most crowded trade in the market, that everybody is piling into them. I've showed you the charts in the past that show how much the NASDAQ is exceeding the rest of the market. I've showed you charts that show how the top 5 companies by market cap are exceeding the market by a large margin. And on that score, Goldman Sachs also weighs in and says that, given the fact that these firms now account for 23% of the total market cap of the S&P 500, to get further upside would mean that we would have to start pushing basically a large proportion of those companies into badly overextended pricing territory. Now, what that means simply, and this is something I've also said before, is that as you continue to accumulate stocks, the question you have to ask yourself is, where do they go from here? They cannot continue to go up indefinitely, Tesla notwithstanding. But essentially, the thesis that a lot of the heavy hitters in the market are adopting is that what's going to be required to maintain the overall rise in the stock market is broader participation. What that means is participation from mid and small cap stocks, and right now that's not happening. So here's my take on it, and it's something that I haven't really seen mentioned very much, but an article I saw recently on Market Watch reminded me of it. One of the things that people overlook a little bit in the US stock market is that it is, in some senses, the one stock market in the world that represents the entire world's market, and not just because of the amount of market cap, but also because there are so many companies in the US market that are global leaders in their area. They are quasi-monopolists. Many of them have market pricing power, which allows them to earn super profits, particularly in the tech sector. They face few competition, little competition, companies like Google, for example, which means that they can, in fact, set prices, and that helps them to really, in a sense, dominate not just the US market, but global markets, because so much of their earnings come from global sectors. So here's a chart I want to show you that shows the top 20 companies in terms of earnings, or rather returns, this year in the S&P 500. So basically, this shows the year-to-date return for those companies. I pulled these stats on Wednesday this week. The market cap, and then the proportion of earnings that come from outside the United States for those companies. The ones in bold are the ones that have significant offshore earnings. The average earnings outside the United States for these companies is around 52.3%. Now, the significance of this is that as the rest of the world recovers from COVID, and we've seen Europe make tremendous strides, notwithstanding some backtracking in some places, these companies benefit from that, and therefore it is reflected in the US stock market because they are US listed companies. So one of the things that we're seeing happening, I believe, is that the success in the rest of the world in controlling the virus is actually supporting the US stock market in ways that a lot of people sometimes overlook. Now, the question is, what would it take for the rest of the market to catch up, and what would happen? Well, here's my thesis. First of all, here's a chart that shows the relationship between a large cap ETF for the US stock market, that blue line, and then a mid cap and a small cap ETF. So basically, these are the performances over the last year. Now, as you can see, the small and mid caps actually kept pace with the large caps pretty consistently right up until about the beginning of this year, when the large caps took off, as they are often wont to do at the beginning of the year, particularly the tech stocks. Then reality hit with the COVID outbreaks in the United States, and everything fell apart. Well, what's interesting is that the small and mid caps have not recovered. Basically, the small caps are down by somewhere between 15 and 20% for the year. Mid caps are down by about 10%. And if you look at that spike at the beginning of June, they have basically fallen since then, and they have traded sideways since then. And that is because of the second wave, or rather the second wave of the first wave, I guess you could say, of the COVID outbreak in the United States. Now, this next chart shows the relationship between US large caps and their European counterparts. Basically, a reading of 100 means that they are performing about the same. So you can see that for the large caps, the blue line, US large cap equities have outperformed the European market by a substantial margin and continue to do so, although they have flattened off since the beginning of June. On the other hand, if you look at the small and mid-cap stocks, the red line, or sorry, the gray or black line, you can see that they were beginning to recover and exceed European performance until mid-June, when they began to tail off again. Now, here's the significance of that. We're all counting on a revival or rather on a vaccine or some sort of cure or something in order to support a revival of the US economy. But when that happens, I think what these charts suggest is that the money is not to be made in the large caps, the big companies that are currently benefiting, but rather they're going to be made in the small and mid-cap companies, which are more US focused. So a smart investor right now, I think, should be positioning him or herself in those kinds of companies. Now, these are the kinds of companies that serve US markets. They're involved in things like the food supply business, transportation, all kinds of things that involve domestic US economic activity. They're getting beaten down right now because the market is reacting to the resurgence of COVID across the South, particularly here in Georgia, for example, in California as well. And as a result, I think there's a tremendous value opportunity there. So my advice for this week is have a look at specific companies in the small and mid-cap sectors that focus on supplying the domestic US market. Right now, they are in a value zone. My prediction is they're going to stay in that zone. They might continue to decline, but the critical point is that when the vaccine comes out, whenever the cure is found, whatever it is that takes or allows us to get going again, it's not going to be those mega cap stocks, particularly in technology, that are going to benefit. It's going to be everybody else. And the everybody else is where you should be positioned. Now, there are lots of ETFs in that sector. There are many ETFs that cover small caps, mid caps. You can also buy them in terms of whether they're growth or value oriented. And I think that's really where the big play is going to come when the market turns and begins to consolidate and begins to see more market breadth. Now, the reason that's important is because it's always important to look forward to what's coming next. I'm convinced that the large cap technology plays are reaching their limits. We've seen this week, I'm recording this on a Thursday, we saw a pretty significant pullback. We've seen resistance in the NASDAQ to break to higher levels. And I think that's a sign that we're going to see that particular part of the market giving diminished returns with increasing volatility going forward. So again, if you want to make good money going forward, it's going to be the small caps and the mid caps. But the trick is you want to buy them, you want to hang on to them, and just be prepared to hang on to them at low prices with potentially a lot of volatility. And as soon as we have a clear indication that this crisis is ending, they're going to take off like a rocket. So that's what I'm recommending everybody do. I'm certainly positioning the Bauman Letter for that. Anyway, once again, you could subscribe to the Bauman Letter up there, or you can subscribe to the Bauman Daily, which is free. But it's always good to talk to you, even my detractors. So great. Have a good weekend. Bye-bye.